Good morning, ladies and gentlemen. Right, well, let's talk about this debt ceiling. First thing to know is that there is no X date, because X would imply that there is an actual date at which the debt ceiling kicks in, and because the Treasury has so many accounting tricks that it can use up its sleeve, we cannot say that there is an X date, even if even the Treasury doesn't know what that X date might be. So talking of an X date is really pointless, because if even the Treasury doesn't know what it is, then how are we supposed to know? Most important thing to know about the debt ceiling is that the deal will be done. Now, what are the deals on the table? Well, the Republicans have passed the budget, and therefore that is the starting point for an agreement. What does that budget actually look like? Are there any cuts in 2023? No. There's 150 billion worth of cuts in 2024, and all the other cuts that they're talking about, the over 1 trillion worth of cuts, are in years 5 out to 10. So it's very much backloaded. What's going to happen in 2 years' time, 3 years' time, what the political constellation is going to look like, who knows? So really what we're talking about is 150 billion worth of cuts in 2024. That is the only thing that they are debating. So that is the starting point. Will they get 150 billion? No, because that is what negotiations are about. So 150 billion is the Republican position, zero is the position of the Democrats. So a deal will be done somewhere between 0 and 150 billion. Let's assume it's 100 billion, okay, that the Republicans win, in inverted commas, and they get 100 billion. What's that in terms of GDP? That's about 0.4% of US GDP. Would it be a complete tragedy if GDP was cut by 0.4? No, not really. What it would enable would be the issuance of well over $1 trillion worth of debt to fund the deficit, and that is what at the moment the bond market is worrying about and discounting, that a deal will be done. It's really immaterial whether it's 50 billion or 100 billion. We know that that is roughly the area that they will agree on, because they will have to agree at the end of the day. Whether it's at a minute to midnight or a minute past midnight is neither here nor there, because we don't know, as I said in the beginning, what the X date is, and therefore what midnight is. Not even the people in the room negotiating it know. Therefore, it really doesn't matter. We will have a deal, and the volatility that precedes a deal will be priced out at some stage. Now, what do we know that happens after a deal? Well, first of all, the TGA has to be replenished to the tune of about $500 billion. That means that about $500 billion will be issued in terms of bills, and then we need to issue something like 1 trillion worth of coupons between now and, say, the beginning of next year, Q1, let's say. So we will have ramped up coupon issuance, and we will have more bill issuance, much more bill issuance. That is likely to draw down the RRP. So because there's over $2 trillion in there, that will probably fall a little bit and help the Fed. So even if the Fed does nothing, and the likelihood is that the Fed will do nothing, that's what the market is implying for the Fed action in June, likelihood is that the pressure will remain on the front part of the curve simply because we have so much issuance. This is the 3-month bill, and as you can see, it's basically stuck between 5% and let's call it 540. That is likely to remain in this kind of an area simply because the Fed doesn't really want the bills to move too far above its target range for Fed funds. But on the other hand, it doesn't really want them to fall below. All the action is going to be in the coupons. So if we look at the 2-year note, it closed right at 427 on Friday and basically spent all week going up. Where is the 2-year note likely to trade? I keep on insisting about this fact that we have this negative yield curve, and when we have so much supply coming at the short end and at the medium to long end, it is natural for this for twos to start giving up some, because even if you're bullish on the economy, even if you are even if you are bearish on the economy and you say that all these cuts amounting to, let's say, 0.3, 0.2, 0.4, whatever it happens to be, of GDP in 2024 is going to hit the economy, which I don't think it's really realistic to say a 0.3 or 0.4 deal is really going to hit the economy all that much, simply because we don't know if that's going to be made up by the private sector or not. That still impinges on people's willingness to buy the extremely short end if they can't see any reason that the Fed will cut rates soon. So higher for longer implies that the 2-year note keeps on slowly going back up towards this 442 area, if not fill this gap all the way up to 455. To me, the 2-year note is a short at every opportunity you get when it basically rallies and returns to this kind of yield, 408, 410. To me, we will return towards the 455. The fives are the ones which are where people base their bullish expectations of bonds, because if you can't do it at the very short end in twos, then you're going to go further out the curve, and the only point which has any duration and you can put some bullish bets on is fives. But I would have thought fives are now going to be 361 at best, and naturally tend to go towards 382. That to me is the range for fives for the time being, and the tens, as you can see, really if you start breaking the 370 area, you are looking to go up here, and that's 383. That would not really be a ridiculous level to trade in tens. 30s are the ones that are going to be the least impacted, because we already are at extreme levels in 30s, and I think that this kind of behavior is going to be repeated next week, i.e. you go back up to 397, 398, 399, come back towards 388, and then slowly go back up towards 405. I think this is a trading range. I really can't see 30s above this kind of level, and let's have a look at why. This is basically a chart of the real tens. It's very hard to see that we are in a situation which is worse than we were at these levels when we didn't know what inflation was going to do in the future. We now have a lot more transparency than we had in October of 2022. We have, over 6 months worth of data of what inflation is doing. So we know how it's moderating and the speed it's moderating at. We can argue about how sticky it's going to be, but we can no longer argue that inflation could accelerate at the moment, or certainly we don't have any data which shows us that inflation is accelerating or is likely to accelerate. We have data that says it could remain sticky at levels above 2%, where the Fed wants it to be. And therefore, yes, can we get to 1.5% real? Of course we can. But what I would argue is that we really can't get beyond 166. So what that is telling me is that we could have an extra 8 to 10 basis points worth of real rates on top of where we are at the moment, which gives us a cap about 10-15 basis points from where we are, even with all the issuance that we are pricing in. If we then look at something like the 5-year forwards, is that breaking out in terms of inflation expectations? No, it's basically trading in a range down from 220, 210, up towards 240, 250. So if we know that inflation is going to be, or we think we know that inflation is probably going to be sticky around the 2.5% to 3% area, and we know that 1.5% in real yields is what we're looking for, then we know that tens are going to trade somewhere around the 4% area. Armed with that, let's go back to a chart of the tens. So what we are saying is that even with all the issuance, we are looking for these kind of levels to be a top. It's very, very unlikely that we go through them, and therefore we have our basis for the trading. We know that any kind of a dip down towards the 350 area is going to get bought because of issuance. Any kind of fears that we're not going to get a deal if we come back down here is going to be a wonderful opportunity to load up shorts looking for this 390 area. That is all we are doing at the moment. I would argue there is absolutely very little chance for the time being that we break these levels up here, or that trading at 390 is not a good term long looking back for around this 340 area. We are probably in a trading range for a long time. The Fed is going to remain tight. That is going to be a bullish argument for the longer end. And the Fed remaining tight is a very good argument for higher for longer and for a yield curve which slowly flattens again, looking for some kind of a, let's call it recession, but not in 2023, but in 2024. So what is the yield curve doing? Well, as you can see, this is 2s, 5s. And slowly it's filling this gap, and it's going to go back to 64. It's just trading around, but basically it shows you that the 2s are giving up hope of cuts by the Fed anytime soon. And then people move out to 5s, looking for, something to happen in the period before the expiry of the 5s. While the rest of the curve, especially the 530s, I think is slowly going to move back towards this 10 and possibly towards 0. There should be least pressure on the 30s, because let's face it, if we what have we learned so far? We've learned that we really shouldn't go above 1.5% in terms of real rates. we will have a lot of issuance, therefore there will be a lot of pressure on bonds, which comes and goes with the issuance. But if that is the case, and we know that the Fed is going to be higher for longer, the possibility of an accident always exists, and therefore the pressure should not be on the very long end. The very long end should be reaching its maximum potential. Let's go back to 30s. All we are arguing in 30s is whether the top is here or over here. The movement in the 30s should be very, very limited, and the movement should all be really in twos, going back up towards 450, this 420 to 450 area, and in tens going back up towards the 380, 390 area. So really you're looking for the tens 30s to possibly get back towards minus 15 as the front part of the curve gives up relative to the back part. Don't forget we traded them, we got at 6.5. So this is where we traded 10s, 30s to on the way down. Would a return to this kind of level be ridiculous, or even, this kind of level? Absolutely not. That would be the normal path of trading, and then we would possibly have another move lower. So I think the yield curve will continue to flatten for the next few weeks. And then after that is over, only then can we look for a period of steepening. So flattening for the time being, the bids are going to be at the long end because that is closest to equilibrium. And that is really what the German curve is telling us, that we're going to have some pressure on bonds overall worldwide, but it's not going to be the end of the world. Can the Schatz go back towards 3? Absolutely. And I think if it comes back to 268, odds are that it goes to 3. Here we are, we're trading technically very nicely in Germany. Basically what this is telling us is that we are not going to go a million miles from where we have been. And if you think about it, the German curve is the one that should be under pressure because the ECB is the one that is still tightening. And it's still saying that rates are going to go higher. We don't know the speed, but we know the direction. And if there is very little pressure on the German curve, that will naturally limit any kind of pressure on the US curve. Let's have a look at the differentials, which could go out slightly for the time being. As you can see, we definitely have some pressure for going out. But really, it's going to be limited towards the 10-15 basis points. This is Schatz 2s. Can it go to 165? Yeah, but I think it comes straight back down. 5s, can it go back up here towards 142? Yes. But 135 to 145, I'm a seller looking for another 30-40 basis points downwards eventually. So what I'm saying is that I don't think the US curve goes a million miles from here. I think there will be pressure, and I think every time you get a decent rally, it's a sell, both in Germany and in the US. But I don't think that this is a trend in bonds. I think it's a flattening because of all the issues that we're going to have, and the fact that a lot of people who bought bonds and sold equities on the back of, oh my God, there won't be a debt deal. There's always a debt deal. The question is only how much less spending the deal implies. I don't think it's a tragedy to be without 0.3 or 0.4 of GDP for 2024. And therefore, I think the pressure in the bonds is not going to be huge. It's going to be limited to what I showed you. The US dollar, if I believe that we are limited in the inflation differentials, but they could go maybe 10 basis points more in differential between Germany and the US, and that bonds are going to find are going to test rather higher levels, and the yield curve is going to flatten, then you are looking for potentially the dollar doing slightly better than it is, but not going a million miles. It has broken the 102.82 area, and basically this is going to act as support now. Where is a target that we could go to? Well, I would argue it's this area, just below 105 to just above 105. And, basically test the 200-day moving average coming down. But again, everything that I'm seeing in the bonds and in the dollar is telling me that the ranges are not going to be huge, that these aren't i.e., these are not impulsive trends, that we are not getting directional trends at the moment. If we have a look at Euro USD, what does that imply? Well, it implies the possibility of retesting below 106 towards this area of 105.20. I don't think it's going to happen next week. I think filling these gaps down here towards 106 is probably the best you're going to get, if at all. I still think that these areas are going to be very difficult to break without a fundamental reason, and I really don't see what that fundamental reason is going to be at the moment. So I think it's going to be a continuation of a technical market, which is now oversold, but that has very little impulsion both on the upside and the downside, simply because I can't see the differentials changing that much, or that there being a trend in the differentials, and therefore I really can't see that the dollar is going to make major moves. Gold continues to trade very well technically. It touched 1859 and back up to 1980. I don't think 1959 is going to hold. I think it's much more likely that we get like an ABC structure, and we do eventually touch 1881. And that should coincide with a high in bond yields. And then we can have a lowering of bond yields and a rally back up in gold. I think if you get an opportunity now to sell anywhere close to 2000, you should probably take it. I would urge you to be slightly short of gold. How many times did we have this opportunity to break 2045 and we haven't taken it? That to me tells me that any kind of a rally up to 1995 or something like that is going to be all you get in terms of higher gold prices. And then we test this 1881, we break 1959 eventually, and then we test 1881. Look how nicely that would look on the weekly charts. We come back down to 1881. This is where all the moving averages are. We hold that level and we can go back up. That would be the way I would integrate the fact that I don't think the dollar is going to go a million miles higher, but it's going to keep some pressure on gold, that the yield curve flattens and therefore put some pressure on gold. Gold, breaks eventually, comes back down to 1881, and that's probably all she wrote in bonds and gold and the dollar. Nothing to write home about in DBC. It's still headed, I believe, to at least 2175, if not this 2058 area, which is like the 100% of an ABC. This is the kind of area that I still want to buy it. This chart is still saying to favor DBC, to favor gold over DBC, but there's not much in it. It could easily come back, but eventually I see it going back up to 9 at least, or even 10. So I still prefer gold to DBC, but that's neither here nor there. You know, we bought it down here, 638. We're happy bunnies. There's nothing wrong with it. Copper, I still haven't got my 350 level, or 350 005, whatever it is. My bid is in there. I'm hoping for a move down to get it. And the fact that this is the gold copper is, hesitating at these levels before turning back up and allowing these moving averages to catch up tells me that I'm probably, it encourages my view of bonds, that they're not going to go a million miles to the upside, but there is going to be some upside pressure on them. And finally, oil, because we know there's a lot of oil. The short-term trend is definitely bearish. And I'm hoping for a dip back down to 64 to 59, which would break DBC down to the levels that I mentioned. And that probably is going to be a decent level to buy some. Equities are basically bullish. That's all I can say about it. I think if we hold 41.64 in the early part of next week, we will trade at least 42.47, and very possibly next week fill these gaps up to even 43. I know that this market is not doing very much, but it's potentially setting itself up to bury all the shorts. That's all I can say about SPX. Really, what we need to do is have a look at other markets and see how they are set up and whether they're indicating any kind of weakness. Because let's face it, the only components of SPX which are going higher are the tech stocks. So we need to know whether tech stocks are going to continue going higher and where we would potentially be worried about them. And then have a look at what the other markets are doing, other foreign developed markets and emerging markets, to tell us where the next impulsion to the upside is going to come from. Absolutely zero weakness in tech stocks. They've filled these gaps and they've traded 13,547. I think if, just like in the S&Ps, if we can't even break 13,547, we have to start looking much higher. We have to start looking at least filling this gap up here, which is 14,800. So, there's another 1,000 points to the upside there in NASDAQ. And let's have a look at why that is actually more likely than not. Now, this is the Dow, the one that everyone's maligning and saying it's going nowhere, blah, blah, blah. To me, all it's doing is flagging and holding the support and really giving the 200-day moving average a very good chance to turn, which it is. It's holding all the levels it should. It's really not bearish. And I think that if you get a push up in the Dow stocks, that will give the NASDAQ stocks probably an opportunity to rest and give the SPX another boost higher. I really expect the Dow to turn and trade at least these levels, at least around 34,200 200, 300. It's just not a bearish market. It's an endless rotation market. So far, tech stocks have led. Maybe tech stocks are exhausted for the time being, and they can just trade around in a narrow range, testing support. That gives the rotation a chance to buy Dow, and that gives an SPX an upward sideways bias, as it were. But everything I look at is saying that stocks in general are going higher. And this is my clean chart, and I'll try to enlarge it for you. Basically, I think that if we can't close below 41.66 next week, i.e. if we just flag, then at some stage we have to trade 42.55, and at some stage after that we have to trade above 4300. Why? 41.81 for the close of the month to me is going to be absolutely key. I've showed you many times my clean monthly chart, which basically has 41.81 as a very important level. If we keep on closing below 41.81, then we can have some sort of an accident. But to me, next week, 41.66 is a key support. And if we can't close below there, I think that odds are that we trade up to 42.55. Long-term chart of the Nikkei. It basically tends to trade around this line, this channel line, in this channel. But what I would say is that we close the week above any other, higher than any other weekly close. That has to be bullish longer term. I really don't care if the Nikkei now starts flagging and coming back down. I think longer term this market has decided that it wants to go up. Let me turn this chart into a monthly chart so you can see what I mean. To a certain extent, same story with stocks, which have broken out and closed the week above the previous high, which was 43.66. Very, very little resistance on this chart now until the 4500s. We can go back in time a long, long way, all the way back up to 2007, and see that above, these kind of levels, all we have is 45.79 in terms of resistance. It's all painting the same picture. It's painting a picture of a market which just doesn't want to know about the downside, and that is corrective. And even the sectors which have been lagging and going down, like the Dow, all they're doing is flagging. And at some stage, the rotation picks those sectors up, and that gives added impetus to everything. So I can't see anything bearish in equities. Now let's see, what does that tell you? If you can't see anything bearish in equities, then you cannot say that bond yields are going to spike a million miles, because that must have an impact on equities. So if bonds are not going to go a million miles, and all you're going to get is a curve flattening, let's say, with 2s and 5s going back up, 10s approaching 30s, and basically nothing going above the 1.5% real, while inflation is stuck between 2.5 and 2.5 and 3. Then you're seeing relative stability once you get to the higher yield levels and you discount all the issuance that the Treasury is going to do to replenish the TGA, etc. That gives stocks maybe a month or two of sideways action, but very, very poised for higher upside. So I really can't see that we are going to get a change in trend in stocks unless we get a change in trend in bonds for much higher yields. And at the moment, I really can't see that. None of the markets that I look are implying that. So unless we're going to see something very strange happening over the next few months, the story is the one that I've been saying since the beginning. Bonds back up slightly to discount the huge amount of issuance. The German curve doesn't go as far as the US bonds because there isn't that much issuance. There's rate hikes. The Fed eventually goes on hold. Whether we have another 25 over the course of the next 3 or 4 meetings is neither here nor there. I don't think that's going to push the bond market very far, certainly not the long end. And then even if we've had 1 or 2 months of sideways action in equities, the market should be ready to go higher in everything. And with that narrative, here are the levels, all the ones that I've changed. Uh, I think really what is going to be very interesting next week is to see if NASDAQ cannot break 13,550 and SPX cannot break 4166 and Nikkei holds 30,400. Those are all very, very good bases for going up. And naturally, it's going to be interesting how impulsive the 5s, 10s, 30s are, and whether all the action is actually in the yield curve, which I suspect. I think 394 or 397 or something like that is going to trade many times in 30s, and that we're going to have many opportunities to make half a point trading it off that 397, 398 area. Eventually, I think we'll probably get to 405, but once we're there, I think it's all downhill. Right, well, thank you very much indeed, and tweet you on Monday.